Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Yeah, that's what it is. And I suppose I can put my camera on now, and so can you, Stu. And we can show we are not cardboard cutouts. Good to see you, Stuart. It's been a rough month for share markets, not a great month for the portfolio, but that's what happens. You know, if you've got the resilience to ride through the bumps, it's very interesting what comes on in the end. And isn't it nice to see that we can do this without headphones? I guess better be sure that everyone can actually hear us.
Should we do that quickly, Alec? I was going to say, what does that say? It's not timing of the market, it's time in the market. That's what we've got to keep to ourselves, in our heads space.
Yep.
But just quickly, let me check the technical things quickly. If you can see Alec and myself and actually hear us, we are trying something new, like Alec says, no headphones. So it's headphone-free webinars, we hope, going forward. And there's a little presentation underneath. Give me there's a little high five button on the control panel on your right-hand side. If you can give me a high five, then we can get cracking. Perfect, Alec, lots of high fives coming through.
Good.
And we do like to keep it quite conversational. There is this question mark on that same control panel. If you can please put your questions in there, and I'll pass them on to Alec as we run through. All yours, Alec.
Brilliant. Yeah, the question mark, click it, and then there's a little text box, type away, Stu will pick it up, and the more difficult the question, the better. Although nowadays, pretty much any question to do with investing is difficult, unless you're Sean Pesh. He's very happy. He's the value investors are having the time of their life. In fact, the best time in 20 years. That was, it's likely that they're going to outperform growth in this period. But you've got to go and listen to that Sean Pesh interview that I did with him yesterday, or watch it on YouTube, and you'll hear some very, very interesting insights from a value investor who says, but they're getting it wrong, and the companies that they put into the value stocks now, including Netflix and Meta. Well, as you can see from the headline here, there's a few changes, big surprises. We've added transaction capital. Stu likes that, eh, Stu?
Transaction capital, I know they're quite innovative. Also good ties in with certain elements of the South African economy, but I think good pick there. I have to put my hand up. I do personally own transaction capital as well.
Well, we do now in the portfolio. What you don't own there is ABSA, and I must say my colleague was rather horrified at the fact that we're putting ABSA in. But every dog has its day, and this is one that Koki Koiman is talking to me about, and I'll give you some details on that a little bit later, why ABSA is appealing at this point in time. Because what we do now, what we're doing now is adjusting the portfolio. You'll see that we had some changes last month. We don't change much in this portfolio. In fact, in the 7.5 years that it's been going, there have been definitely less than 20 changes overall in the portfolio. A couple of them are pretty sore, like Naspers that we sold at about 2,500 Rand a share and thought it was great, and then didn't buy at 1,500 Rand a share when they got there. I can kick myself, Stuart. It's always by not owning Naspers in South Africa, Naspers Strokes process, you are betting that the management are not going to find a way to unlock that huge discount between those shares and Tencent shares. And so help me, out of sight, out of mind, and good luck to Koos Becker, the chairman, and to Bob van Dijk and his team for finally coming up with something that everybody loves. Effectively, what Naspers are going to be doing, they've been given the go-ahead by Tencent, and that was a big thing. Up to now, Tencent, anyway, who knows what happens inside boardrooms, but over the last 6 years, Naspers was only able to sell 2% over a 2-year period, I think it was, 2 percentage points of what they own in Tencent. And they're sitting on 31% of it, $140 billion. That's like a piggy bank that you can't access. Now they can. Now they can access it, and the market appreciated that. Unfortunately, it was one that got away from us. We only do this webinar once a month. If you had been following the Naspers story over the months and years, you'd also have looked at that and said, come on, at some point in time, the discount has to narrow. I think the discount got to nearly 70%. So you were getting Naspers for free plus a discount of 70% on Tencent shares, which they can sell in the market now. So it's one of those that in the noise and in the turmoil is very easy to forget. And one I haven't forgotten is Transaction Capital. I've been following that for a long time. I love the business. Actually, Stu, if you get a chance, maybe you can put up in the chat box that link to the David Hurwitz interview when he came in here. It's a stock that has now come down significantly and is at a level where I'm sure even Warren Buffett would get interested. A similar story with Palantir, which we bought into initially when it was at a deep discount to the price at which it traded in its IPO. But anyway, we'll get into all of that in a moment. And as mentioned earlier, Stu will give you he'll stop me as soon as you have got questions that you'd like to pose. Let's kick off here. It was a really rough month in June, as you can see there. Our portfolio was down by 5.5% in US dollars, which is in between where the NASDAQ and the S&P 500 went, and a little worse than the JSE All Share Index, which was helped by that huge surge yesterday in Naspers process. Otherwise, it would also have been aligned with, in fact, it was up 2.2% yesterday. So it would have been 6.5% if Naspers process had not come out with their results. A little bit worse, that is, than the S&P 500 index. But in rands, the rand was a bit weaker. So our portfolio in rands, just over 8 million rand. It's well worth remembering, often in times like this, when share prices are under pressure, it's worth remembering the value of a long-term investment. This WebTrader portfolio was started in December 2014, and it was 2.2 million rands. It's now over 8 million rands. So although at one stage it got over 10 million rands, it is still important to remember that investing in shares is long-term. You're going to have the ups, you're going to have the downs, but as long as you can be resilient in your own mind and hold on to it over the long term, you should be well treated. And that's pretty much the situation, as you can see there, the power of compounded interest over an extended period of time. Dollars, we're at $517,000, down $40,000 in the past month, but remembering that we started this portfolio with $200,000. So it still is a pretty useful return when you have a look at it in that way. What's going to happen from here, of course, is anybody's guess, but let's just look at the portfolio as it is ahead of the changes that we made today. And those changes were telegraphed last month. We did say, well, at least half of them anyway, that we would be adding more Palantir and more Meta platforms. Why we do that with offshore shares is that we buy them in chunks of, 1/3 at a time. So essentially, if we're going to buy Palantir shares, we will buy 1/3 this month, 1/3 the next month, and 1/3 in another month's time. So we bought 1/3 of Palantir last month, and you can see there, and we've now gone forward and bought another 1/3 this time round. There's a nice improvement in the share price of Palantir, but a deduction or a fall in the price of Meta, which we'll get onto in just a moment. The changes in the portfolio now for the month going ahead, well, we needed to raise more cash to buy the second chunk of Palantir shares and the second chunk of Meta shares. And also, I have added there 2 new South African stocks, Transaction Capital and ABSA. So what we've done is essentially sold Aveng. Now, I need to tell you a little bit about this. Aveng was a company that looked very appealing in theory. In practice, the more I've been digging into this company, the more concerned I'm getting. So let me just unpack that a little. In theory, Aveng has got a company called Moolmans, which is a mining contractor in Africa. You couldn't ask for a better business opportunity right now than doing that. It also has a construction company that operates in Australasia. So those are the two main businesses that are left in Aveng. The problem with Moolmans is because of years and years of neglect under the old management. Aveng is a fallen angel in many ways. The Moolmans asset base has deteriorated really badly. And as a consequence of that, it needs massive reinvestment to get it back into a competitive situation. This is only something that you get to know when you go and kick the tires and get to understand the business better. At the time of buying into Aveng, I was really looking at it on the top line rather than going through and having the opportunity of talking with people in that sector, because it's been confusing me why Aveng's share price has been under pressure. And often that happens because somebody knows a hell of a lot more about it than you know. So having dug into it more and more, it concerns me that Moolmans, which should be the jewel in the crown, is actually a business that is going to require massive additional investment. Imagine this: you've got plant and equipment which is old and thus uncompetitive against others who are playing in that market. And the result of that, you can't bid for businesses, for contract mining businesses at a competitive rate, or you certainly can't get the best contract mining deals. And that's what's happened to Moolmans. And if you think about it, it makes a lot of sense. Aveng almost went bankrupt, so they didn't really have money to reinvest where it should have reinvested. I'm sure that in time to come, they've got a really good management team. They'll find a way of recapitalizing the business or that business anyway. But it is a concern for anybody who's invested there, as we have been. The other thing is in Australia, the market there, the construction market there is really, really tight. Australia's economy is not doing great. They've had had an interesting approach towards COVID, which has been wonderful as far as a reduction in deaths are concerned, but it's been awful in terms of the economy. So the jury is out there. And having seen the Australian business of Wilson Bailey, which was the jewel in the crown just 2 or 3 years ago, going belly up, you've got to be worried about Aveng's operations there. So all round, I was looking for something better to put the money into. And Transaction Capital was a company that I've been watching for a long time. ABSA, you might have heard the comments that we've been suggesting over ABSA in recent times. The new management team, Ari Rotenbach, is surrounded by guys that he's worked with through the ranks. They've taken on business challenges and achieved them, and yet ABSA's share price is where it was 10 years ago. In a high interest rate environment, banks do much, much better. The higher the interest rates, the more profits that banks can generate. And with interest rates on the rise again, you've got to be looking at banks very seriously. On Transaction Capital, it's just a phenomenal business. And it is one that we've been watching to see when the share price came within a very good value range, and it appears to be there. Going back to the other two that we bought last month, we've had another chunk of shares in Palantir and Meta. And just to remind you, put this in perspective, when we add US shares or offshore shares into the portfolio, we do so in stages because we try to take out the impact of the Rand and the volatility of the Rand, and also the share price as well. When it comes to buying the South African shares, usually what we do, and we've done it again now, is we look at a better value proposition and then switch, because this has been a switch here from Aveng. That's out, and Incomes, Transaction Capital, and ABSA, and we've taken the full chunk. So as you can see there, nearly 440,000 Rand raised in this portfolio from the sale of Aveng, and that was split in half, Transaction Capital and ABSA. I hope that makes a lot of sense. Let me just go into the individual stocks that we bought in the Web Trader portfolio. As you can see, here's Palantir, a bit of refreshing your memory. When you look back now, having bought it last month was a pretty good time, and the share prices touched over $10 again, and it's now just below $10. This is a company that IPO'd at $10 a share. It's led by Alex Hogg and Peter Thiel, two absolute geniuses, and they've focused their attention on data and data gathering and data mining, supporting companies and countries. It's actually made for this kind of a world that we're seeing at the moment, and the revenues are growing at 50% per annum and likely to continue at that level. So Palantir is one of those absolute gems that has been tarnished by the market decline as a whole. A reminder on Meta. Meta is actually a bet on the metaverse. They've now finally managed to change their listing on the on Nasdaq from FP or Facebook to Meta. It's now been classified as a value stock by Russell, which is extraordinary. So it's going into the value stock index. Again, I did discuss this with Sean Pesh in our interview yesterday, and he had some choice words to say. How can Meta be a value stock, he said. But Sean's looking at it on the basis of the company is not growing anymore, and that's true. The bulk of the company isn't. But why I like this company is because of the future that it is offering, the potential that it is offering in the future on the metaverse, which I played around a little bit in virtual reality, and I must say it's mind-blowing stuff. Hey Stu, you've got that VR headset as well. It's so different.
Good fun, Alec. I mean, there's obviously a lot of business aspects, but it's also good escape from reality. You know, that little half an hour in the evening if you just want to go away for a good journey to London or something. It's fascinating with the 360. It's brilliant.
Yeah, that 360, so you can put this on and all around you. Anyway, Meta's made a huge bet here. But how are they going to monetize this? I mean, it was an interview, but a suggestion on how to monetize any new area is that you would probably do that as you would do Oh, sorry about that. We had a little internet problem here. Who knows what's going on nowadays with all the load shedding, and we've got a very strong line. I'm hoping that that everything's going to come through as per normal again. There we go. Vodacom to the rescue, perhaps. I'm sure that this is going to. There we go. I'm just trying to get this up again. My apologies. There we go. Okay. Let's go back to where we were. and we were talking. I'm going to switch off my my webcam. So let's just talk a little about ABSA. And on ABSA, the idea here came from Corky Koyman. Now, Corky, of course, would have been buying these shares since 2020. And he, even at these levels, though, and I put up here a 10-year graph. So it's going all the way back to 2012. And that's pretty much where the ABSA share price is trading at the moment. If you consider how much the company has grown in that past decade, then you have to wonder why the share price has not grown as well. Part of the reason for this is that banks have fallen completely out of favor. The other part of the reason is that interest rates, you will recall, from 2008 until 2016, internationally were virtually zero. Then they bumped up a little bit after 2016 when the Fed started to pull out money in the economy. And then in 2019, everything reversed again, because of the 2020 rather, because of COVID. You can see the impact there for ABSA. It really took a lot of, well, there were other reasons why ABSA took a knock there. They had internal conflicts that were going on with the management team. But essentially, interest rates have been in the worst possible place if you happen to be a bank. Banks do well when interest rates are high. Banks do badly when interest rates are low. And for the last decade, interest rates have been low. When they started rising again, we had COVID, and then interest rates the market was flooded with cash, and interest rates were then once again pushed lower. They've started rising again, and a rising interest rate environment is very, very good for banks. And this is a bank that has got the other benefit, and that is the change in its management team. I'm impressed with Arie Rautenbach. I had quite a long chat off the record to him when we saw each other in Davos. I like what I see. Having worked at ABSA myself, many years ago, that is, I have a feel for where the strengths of this business is. And primarily there, we're talking about strengths being in the mortgages. They have a large share of the South African mortgage pie. What was interesting when I went and had a look at market shares, and I was referred there by Corky Koyman, the market shares of ABSA have been growing over recent times for the first time in probably a decade. So the new management team under Arie Rautenbach is appealing. The share price is back where it was 10 years ago. It's still a solid franchise. And if Corky Koyman reckons this is the pick of the SA banks, then it's good enough for me. After doing all of that work, I'm now very happy that we will add this one into the portfolio, despite Stuart's misgivings, and I guess the misgivings of many other people who haven't got past the negativity on ABSA. But then when we have a look at the next edition, which is Transaction Capital, this is one that is a business that has made its mark among the investment community, and yet it's become a casualty of the neglect of the share market generally over the past year or so. It's a really good interview, that one with David Hurwitz, and well worth going on to BizNews TV on YouTube and watching it, because this is a company that targets what he calls high stigma businesses. What does that mean? In the public perception, there are certain businesses that have got a bit of a smell around them, or businesses that have stigmas, and yet, according to the entrepreneurs behind Transaction Capital and their CEO David Hurwitz, that's exactly where the opportunity lies. They have gone into very aggressively into the taxi industry. And we saw from the July riots last year that the taxi owners are a very strong component of the new South African middle class. And so invested in the system and against chaos, which is really interesting because it's not something that you would have immediately thought about. Reason for this is Transaction Capital is playing an enormous role there in funding taxi businesses and supporting taxi owners through massive data investments. And data actually comes through a lot. ABSA is doing well on its data. It's got incredible data that it can use. Palantir is a data company. Meta has got more data than the rest of us can dream about. And Transaction Capital, when you listen to that interview with David Hurwitz or read through the annual reports and talk to people in that company, you'll see how data-driven they are. It's also, as I mentioned there, entrepreneurial culture, and that you see in We Buy Cars, which is just booming out of all proportion. I went to the opening of the Dome, which We Buy Cars acquired. Apparently, when the Dome, which is a landmark in Johannesburg, or the north of Johannesburg, when it was originally built as a motor car showroom. Never really got there. It was used for concerts and lots of other things, but it is something to behold when you've got more than 1,000 cars that are under one roof. And the We Buy Cars operation is slick. It is reputable. They've worked really hard to make sure that they stand out in that market. And everything that I've had to do with them and to see from them suggests that Transaction Capital has made an incredible acquisition there. And don't just take it from me, Piet Viljoen is the one who put me onto that in the first place. And if you take the data focus, then another area of their business, which is debt collections, is again a high stigma business. Debt collections, certainly in my younger days, was done by Lebanese guys, big Lebanese guys from the south of Johannesburg with baseball bats. That's no longer the case. Now it's a highly profitable business if you get it right. And that's what's happened. Now, Transaction Capital, I've been watching it. The performance of the share price has been excellent. It's just been too expensive until now. So the price has given back all of the gains of the past year. The financial results are excellent. The company continues to grow, and it is well positioned in a South African context. So it is one for a South African portfolio to be added to it. And indeed, if you consider that some South African shares, and particularly financial services shares, are offering excellent value, then this is one that I'm very happy to have now in our portfolio. So there it is, the way the WebTrader portfolio stacks up when you look at it now. There is a cost price. We added some more Palantirs, so the cost price has now gone up to R9.12. It was in the eights. Sorry, $9.12 is now in the eights. So Palantir is showing a nice profit to begin with, even with the addition. Transaction Capital, we've acquired those this morning at R39.07, and ABSA Group R159.35. The price was bouncing all over the place at ABSA, so you might be able to get a little bit cheaper than that. We will be buying that final tranche of Palantir and Meta next next month. You'll see an absentee here is Netflix. We've decided to sell Netflix, not just because of the poor performance of the company in the past couple of quarters, but because it's now rated as a value stock by Russell, Netflix and Meta, both in their new value portfolios. But what bothers me about Netflix was that they really didn't have their finger on the pulse, and the issues that came at them appear to have caught them almost unawares and almost blinded. The issue that Netflix is dealing with now is much bigger than the problem of people using passwords across the place, and that is that they are on a roller coaster of producing content which hasn't worked if you consider that the less is more approach by Apple and most recently Amazon in their content offerings is playing very, very well. We have all of the streaming services. I don't have Disney, but I think you can get Disney quite easily through multi-choice, and I might well do that. But Apple and Amazon produce unbelievable product compared with Netflix, which seems to be a little bit bubblegummy. And although Netflix had a huge advantage and a huge lead, it's being cut back now by the others. Also, it's not as well capitalized as Apple and Amazon, who really, if their whole investment into streaming were to go belly up, would hardly touch the companies. But both of those are doing their streaming as part of a bigger strategy. Amazon in particular as part of their Prime strategy, and that makes it just so much less vulnerable to the vagaries of competition, whereas from Netflix's perspective, that's all they've got. So I'm worried about Netflix. It may well come out in the next quarter. Remember, the quarter end is the end of June with really good results in the next few weeks, and that might give it an uptick. So if you still like the Netflix story, it's not a bad idea to hold on to it. But what bothers me about Netflix is when you have an exponential company that goes X growth, you should not have an exponential rating anymore. And as Sean Pesh pointed out, the value of Netflix is still sitting nearly nearly $100 billion. That's a big number, and especially for a company that has to keep spending just to hold where its current situation is. So yes, I have reassessed Netflix now in the light of the recent results, and that's now out of our portfolio. I do believe that Palantir and Meta Platforms offer a better option. Meta in particular, because the investments that it's making is in virtual reality, which is a whole new area, and then Palantir just because it's a phenomenal company in a great area, and it hasn't been appreciated yet. A little bit like Apple. When we bought into Apple, the idea was always that Apple had an environment, that an ecosystem that with more than 1 billion devices in people's hands, an ecosystem that it could play into, and that was neglected, or the value of it was neglected by the analysts for a long time. Palantir's got a similar advantage, which hasn't really been probably appreciated yet. So those are the changes, and then Transaction Capital and ABSA. Onto the shift portfolio. So whereas we've done really nicely in the long term with the other portfolio, this one was launched at probably the worst possible time, which was in December, not exactly the worst time, but almost December last year. It is on the shift back end, so very easy to buy and sell shares there. It is focused on the United States. What I love about this is that you literally can trade in an instant. It's a very, very, very good platform. As far as this is concerned, there have been some spectacular losers. You see Netflix there down 60%. I decided not to do anything more with this portfolio sorry, that's not true. At this juncture, well, not to add anything new. We have started adding Palantir and Meta, and then you might recall that the intention was to make Amazon one of the banker stocks, to replace Netflix, and the intention there was to wait for Amazon to have its 20-for-1 share split, which meant that the share price went from over $2,000 to, as it is at the moment, $113. And that means that we can make the adjustments, which we'll be doing tonight, also getting out of Netflix, selling that at pretty much the same level it was at last month, and then using the cash that comes from this sale immediately to up the stake in Palantir. You've heard how much I like that company, and then to buy some additional Amazon shares, which will then take the holding of Amazon close to that number of 15% of the portfolio. So in the shift portfolio, I haven't done an update for you because I don't know what we're going to pay. This is what it was at last night. But with that shift portfolio, which started off at $10,000, we'll be selling our Netflix shares and we'll be buying around 91 Palantirs, depending on what the share price is tonight or how much 875-ish dollars can buy you, and then 7 Amazons. So that's the story for you on this portfolio. I'm not sure, Stu, have you managed to reconnect? You are. Okay, brilliant.
Yes, I'm back.
Any questions?
Yeah, sure. John just wants to know the changes to the portfolio. He says don't show tax events. Do they not have an impact on the value over the history of the portfolios?
Yeah, but tax events at this point in time are not a negative. So that's, if you consider Netflix, we made a terrible loss on them, and Avenge, we also lost money. So those are tax events, which then can be put against previous profits that were made, I guess, if that's the way that the Inland Revenue is viewing you. But on these things, everybody's tax affairs are different. All I'm doing here is giving you a model portfolio. So I'm not suggesting for 1 minute, please, I'm not a money manager. I'm not suggesting that you replicate this portfolio and then this is it. What I am suggesting is that you use this as a guide and you do your own thing. You might decide, oh, this Hogg's he's nuts. I'm going to keep Netflix. It's a fantastic company. Or what's he thinking about with Palantir? That's what makes a market. But the idea here is, particularly in a case like that, if you're going to buy and sell shares, just check with your financial advisor or with particularly your tax advisor, and then shape it accordingly. What I'm trying to do with these portfolios is to say, get involved in buying equities, but get involved in the right way. When you buy, hold forever unless there is a fundamental change in the underlying business that you bought into. And we don't always know. Well, of course we don't know, because the future brings lots of surprises. To me, when you sell is the time you really got to think about it long and hard. And Netflix needs to be sold because it was an exponential company. That was why it was in the portfolio, which has gone X growth. And if you have an exponential company that goes X growth, it's not exponential anymore. So that one's easy to work out. With Avenge, as I mentioned there, I'm very concerned about Moormans and the capitalization of Moormans, and also the other part of that business, which is an Australian construction business, and that both of those industries have turned down. So the fundamentals in that company, according to my reading of it anyway, are no longer as bright as they were on paper, and it is something that you need to make your own view on. And perhaps if you have a different view, well, maybe you're going to be the right. Remember, I sold out of this portfolio Naspers, around 2,500 Rand. Sure, it went all the way down to 1,500, but it's back to nearly 2,500 in a falling market. And the famous Tesla, which we sold in 2018 at $300 a share, and it's had a share split. Was it a 4-for-1 share split, and then another share split? And anyway, that one looks really silly. And I hope that you ignored my views on both of those. But if you didn't, anyway, we've had enough winners to kind of offset those losses as well. But that's what it's about. It's to start getting involved and to start teaching yourself and to start learning, because you learn best by experience. And the experience in shares is money is made by being resilient, by ignoring the vagaries of the market, the bulls and the bears. We don't know how long a bull market's going to last or how long a bear market's going to last. But we do know that if you hold through the cycle and you buy good companies that you understand, you will get a decent return.
Thanks, Alex. Serena asks if you can please just show the shift buys again.
Of course. There we go.
Are we doing that? Yep.
There we go. Okay. It's we're selling Netflix, and we're adding to the Palantir and the Amazon holdings. You might recall last month we bought Palantir and Meta into this portfolio, you can see that the shareholding there is they're around 5% for Meta. Palantir actually went up to 7% because the share price went up when everything else went down. So we're now going to have Palantir as a banker. So from after tonight, we'll have Apple, Microsoft, Amazon, and Palantir as our bankers, around 15% each. We've got Invesco, which is the exchange traded fund, sitting there at around 20%, and then the rest are all wild cards, really, at 5%, and with a little bit of Bitcoin. You recall we bought Bitcoin at initially 2%. It was 4% of the portfolio. We went into MicroStrategy, Michael Saylor's company, which is, he's been given a real rev recently, but he came out punching and saying why his company is still very much solvent, and why he still believes in Bitcoin and Bitcoin itself. That exchange traded fund, which is an investment in Bitcoin, is down 54%. And you might recall when we bought in, my concern in the next month when we were going to buy the next tranche was it was a heck of a lot of gale force wind coming at Bitcoin at that stage, and we've just stuck with what we've got, and we'll leave that the 2% in Bitcoin there as insurance, which is what their professional money managers say you should be looking at Bitcoin. Have some, so it keeps you interested, but don't go too heavily into it because it's highly volatile and very risky.
Alec, I know you mentioned Naspers and Prosus at the beginning of the portfolio, but Benji wants to know if you've looked at it, the announcement, as I know you have, but if it's not a potential buy going forward still.
Benji, I could kick myself. I really rate those guys. I rate Bob van Dijk and Basil Skordos. I rate Chris Becker as probably the best entrepreneur ever to come out of South Africa. The fact that he took the view that he did in the year 99 and 2000 and Anthony Roux, and he believed that the internet was going to be the next big thing. Off they go to emerging markets, and the idea was just place bets, throw mud at the wall. That's the way Anthony Roux described it, and some of it will stick. And they went along to Hong Kong and found this little company called Tencent and bought 50% of it for $30 million or so. And that $30 million is now turned into, well, today they got $140 billion from that investment. It's been described as the best the best venture capital investment in history. So I rate them, but the market didn't. And the market was very unhappy with the different attempts that they made to unlock the value that existed between Naspers and its shareholding in Tencent, that 50% that it bought, I think, in the year 2000. Our mistake was not keeping an eye on it and going into Tencent, into Naspers when it got to ridiculous levels of discount, and believing that or forgetting that Chris Becker and Bob van Dijk and Basil Skordos and their team would keep looking for a solution to unlock that discount. Now they've finally done it. The announcement yesterday means that they've got this piggy bank that they can draw on for as long as they like to take advantage of the market inefficiency, which is it's quite simple, really, when you look at it in broad terms. You've got Naspers is sitting it was sitting at a 60% discount to the shares that it owned in Tencent. But the problem was it wasn't able to sell those shares in Tencent because there was an agreement between the South African company and the Chinese company that those shares would be locked up for all intents and purposes. And they were allowed to sell 2%, 2 percentage points of their holding over a period of time. And I think in the last 5 years, they've sold 4 percentage points of it. But they're still sitting with 31% of the company. The transformative decision yesterday was that they are now allowed to sell as many shares as they like. And what excites me about this is not just that it's going to close that discount gap, but remember what's happened to the companies in the market that they were looking at. They nearly paid 10 times the current price of Just Eat, a food distributor in the UK. They were in a bidding war for it. And as Bob van Dijk asked him about this yesterday in the telecon, and he said that he was very happy that they kept their discipline and they didn't go one higher. They could easily have gone one higher. They've got plenty of capital in the on the balance sheet, but they didn't. They showed discipline, and as a consequence, they lost that deal. And of course, today, sure, thank goodness. And then you look at a company that we've got in our portfolio, like 2U, which has dropped like a stone. It's a fantastic business. They have a market cap less than what they paid for buying edX, and edX and 2U and all the others would fit beautifully within Udemy, which is part of Naspers, and Naspers's whole online education play at a price that is just such bargain basement. So yes, the Naspers stock is very, very appealing, and even now it's still at a discount of around 30%. So it's not as juicy as it was at 60, but I don't think that you should be discounting that. The only problem in all of this, the only big problem in all of this, is that Tencent has now become a target of the Chinese Communist Party. And interestingly enough, Tencent shares were down sharply again yesterday, while Naspers went up. But of course, there were different reasons for it. I'm using Naspers. You could throw Process in there as well. And the issue for Naspers is that as it sells its Tencent shares, while the Tencent share price holds where it is at the moment. So you've got lots of, as always in markets, you've got lots of things in play. So it's not a slam dunk because of the Chinese Communist Party and Tencent, but it certainly is an appealing investment attraction, and one that we should have bought last month.
Thanks, Alec. Bo just wants to ask about Zero. It seems to be struggling on price. Do you know what's happening with it?
No, well, there's no change to the fundamentals of the company. It's a phenomenal business. It's a little bit, I think, like Palantir and Transaction Capital. When you're in a bear market, all ships sink, even the really, really good ones. And Zero, there's nothing wrong there. I'm still in touch, looking at it, reading through the stuff. The product is amazing. It's getting better and better all the time, gaining more market share. If anything, Zero should do better under a more difficult business environment, because you would move to more efficient processes, and online computing, online accounting, it doesn't have anyone close to it. And as a consequence of that, Zero is set fair. But it is a tech company. It is an exponentially growing company, and all tech companies at the moment are being looked at askance. You know, lest we forget, Amazon dropped by 99%, the share price, after the crash of the Nasdaq in the year 2000, and of course it rebounded to more than 10 times the price that it was at before the crash. So it just shows you, investing in shares, you become a co-owner. If you're a co-owner of a business and times are tough, or your management team is doing well, but people outside look inside and they're not so sure about it, you don't lose confidence in it because somebody outside is making a judgment on it. Remember, as Warren Buffett says, that price is what you pay, value is what you get. For me, Zero is offering even better value today. So I'm not changing any of my thoughts on that one. There's been no reason to change that. It's not a Netflix. Netflix has had a business model that we all believed in, that they continued telling us about. There was a misstep and they said it's just a temporary thing. We're going to be growing again next quarter. Well, now we see that that misstep was a lot worse than that, because the following quarter they actually contracted. It's not like that at all at zero. Zero, if anything, is even better positioned now given the tougher economic times.
Thanks, Zach. Brian asks, I know you added Meta on the web trader portfolio. He wants to know why you didn't invest in it in the shift portfolio with regards to the second tranche.
Because it's a wild card. Meta is very much Palantir and Amazon are bankers, and they're going to be 15%ers, if you like. Meta is a wild card. It's in the wild card statement, and that's because it's taking a huge bet in a whole new area that I'm very positive about, virtual reality. But who knows? You know, will this whole new area, will they be the winner in the metaverse? It's kind of open for question. Whereas I'm very confident that Amazon and Palantir will be winners in their particular areas for many years to come.
Thanks, Alex. Serena just has a question with regards to the strategy around selling Invesco QQQ in order to finance potential bargains in a falling market.
Yeah, that's Invesco is a little bit like, we did this with the web trader portfolio. In the early days, we had a big chunk in the S&P 500 index, and in Berkshire Hathaway. And what happened was that progressively, as opportunities arose, and we didn't really want to sell anything that we'd already bought into. And it's similar here. I wouldn't sell Cloudflare if you put me on a torture rack. The fact that Cloudflare is down 51% is, to me, is neither here nor there. This is a company that's growing 50% a year and has got a lockhold on internet security around the world. It beggars belief to me that the share price is where it is, but that's fine. Somebody probably knows something I don't know, but until it's shown that I don't know what, or I didn't understand what was happening with Cloudflare, then I don't want to sell it. I don't want to take that chance. And similarly with Uber, Spotify is an interesting one. Zoom, 2U, we sold 2U in the other portfolio, in the web trader portfolio, because it had become just irrelevant in the whole scheme of things. But who's to say that Naspers isn't going to go there and buy 2U for $15 a share? A little bit like what happened with Twitter when that was bought, when we sold there at Elon Musk making the bid at 54, and I think we sold just under $50 a share. So there's no fundamental reason for any of these shares to be sold in this shift portfolio. But when something comes along that I've done my homework in, and I would like to point you towards it and keep updating it in the Invesco QQQ, in this context, some of those shares, some of those ETFs will be sold to purchase that stock, whatever it might be. There's a few that I'm looking at, and I'll keep looking at them. But then a little bit like transaction capital, you've got to wait for the right time to buy into those shares. This portfolio, we couldn't. We started off at $10,000 in December last year, and we added another $10,000 and a third $10,000 in the 3 months. But we added all the shares to spend the whole $10,000, invest the whole $10,000. That was what the process of the portfolio was. But from here onwards, there will be if something comes along and an opportunity exists to acquire a share like a Palantir, say, well, then the decision will be made to sell more of the exchange traded fund and then to invest it into an individual. When you have your own portfolio, you might be a little more risk averse and you might decide to go into an exchange traded fund. But it's interesting to see the performance of Apple and Microsoft has been a lot better than Invesco ETF has been since the installation of the portfolio in December. So it's not always, an exchange traded fund doesn't always give you the protection that sometimes you think it does. Stu, are we okay? It looks like Stuart's gone, unfortunately. So
Just
what
got
I'll
back,
do is,
sorry.
are you back? Okay.
So I think load shedding and internet connections is a bit of a challenge.
Challenge.
But, yep.
All right, I can't hear Stuart. So what I will do is I'll pick up here with the question, why are you not accounting for dividends in the web trader portfolio? That was a question from Mark. Mark, we are. I haven't added dividends this time around, but we generally do, and that gets added to the cash. Brian's question is there a reason why we're not investing in Meta on the Shift portfolio? That was the one that Stuart asked a moment ago. Sean says, are there any specific alternative investment portfolios that you look at or take cues from? Example would be Berkshire. Sean, yeah, interestingly enough, on Berkshire, when Warren Buffett bought into Apple, it certainly gave me the confidence to increase our shareholding in Apple way back when, and that's been a good one. You watch the experts all the time. I watch Howard Marks very closely, and you might notice that this week Howard Marks was explaining that he thinks that the bargains, it's time to start buying again. So he's a guy that I follow. Again, he was anti the tech shares. He bought Bitcoin at the top of the market. Nobody's perfect, but usually these smart operators are people that you'd like to watch. I was very keen to add Abn Amro to this and to the web trader portfolio, and indeed also to the Shift portfolio, but it wasn't. I wasn't able to, and the reason for that was that Koki Koiman it gave me a whole long story about Abn Amro and why it's trading at price to book of 0.6. Again, I got confirmation yesterday on Abn Amro from Sean Pesh, who was explaining that BNP Paribas has been buying Abn Amro shares. So a lot of these interviews that I have with these money managers point you in a direction or another. So it is a very useful place to pick up understandings or interesting ideas. And then Dave says, I'd be interested to hear what lessons we can learn in the Avenge purchase decision. Were there shortcomings in the due diligence that didn't reveal underlying problems leading to a purchase based on top line? Yeah, Dave, I think that many of us were very excited about Avenge. What caught me was just the top line, really. Here they are operating in the market or in mining construction in Africa, and they had a pretty solid business in Australasia as well, and good management team. And they added Bernard Swanepoel, you might recall, to their non-executive directors. He's a savvy operator. So all of these things combined, plus Piet Viljoen had it as one of his bundles. And when I read through Avenge, it looked like this was the classic turnaround situation. A company that had been through the mill, had managed to be rescued, had come through, got good management, everything was moving in the right direction. But it did fall out of favor with investors after its most recent set of financial results. Again, as an outsider, you only can read what you see in the financial statements, and then if you kick the tires a little bit more, you might have an opportunity to learn a bit more. I've been confused by this one, really confused by Avenge, and particularly because I would have thought that Moormans would be absolutely flying right now, and then as a consequence of that, it would be pulling Avenge as a whole higher. But then when I did my homework on that, it proved not to be the point, and as articulated in this conversation a little earlier, I think that's what it's about. That's what investing is about. Companies are dynamic vehicles. They change all the time. They're not always what you begin with. Sometimes they get better, sometimes they get worse. And when they get worse and when they change fundamentally, the reasons that you bought them change, that's when you need to reassess. So I think there's been a lot of learnings every time that you buy or sell a share. There's a learning of it. I love the suggestion that's often given that when you do that, when you buy or sell a share, make a little note about it. Why did you buy it? Why did you sell it? And then in time to come, you can come back to it. It's a learning process. Well, thank you again. We've come to the end of our hour. It's been such a pleasure being with you, and I look forward to being back in your company again next time round. So sorry about our internet connectivity issues. It's here in Johannesburg, we are really under the cosh at the moment with load shedding. And although we have USBs and those kind of precautions, it is a challenge. And I think when we get load shedding, it often does play havoc with our connectivity. But we got through most of it thanks to Vodacom. And I look forward to being back in your company again next week. Until then, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.